Hi there, and welcome to the first instalment of the GetGround learning series. Using your own limited company to purchase an owned buy-to-let investment property has become the preferred method of investing for most property investors. There are now over 250,000 limited companies that exist to hold investment property, and from research at GetGround we have found that more than 60% of all buy-to-let purchases made in 2020 were done through companies, as opposed to just 15% in 2015. Investors have flocked to Companies House to set up limited companies for their buy-to-let investments, but the majority of them do not set up or structure their company correctly and miss out on maximising their investment returns, protecting their investments, and ensuring that their portfolio is as flexible as possible. When asked how to set up a limited company, most investors will answer something along the lines of, simply go to Companies House and fill out the necessary forms. Now, of course, you can indeed do this, but by doing so, what you are setting up is essentially a shell which will allow you access to a few of the associated benefits of company ownership. However, a company's value and what advantages it can bring you as an investor is determined by the company's legal structuring and the quality of the company's legal documents. Some of the questions you should be asking yourself when deciding to purchase your buy-to-let property in a limited company are: how do I set up a company so that I can actually maximise my investment returns? How do I set up a company to be as tax efficient as possible? How do I set up a company so that it is compatible with mortgage lenders' requirements so that it can access the best interest rates and LTVs that lenders have to offer? How do I set up a company so that my ownership and rights as part of that company are secured? And how do I set up a company so that I can pass on my property onto my children in a way that is efficient for inheritance tax purposes? The reality is that most investors do not know the answer to these questions and don't structure their companies in the best way possible, in turn missing out on the many significant benefits that company ownership allows for. In this video, we are going to discuss how to set up and structure your limited company so that it is specifically designed for buy-to-let investing, so that you can access the full extent of benefits that come from owning your buy-to-let property in your own limited company. First of all, getting company creation and structuring right can be very complex. If you choose to take the limited company route when investing in your buy-to-let property, then it is wise to use a provider who specialises in this field so that you can ensure your setup and structure protects the company's shareholders, is tax efficient, allows you access to the best financing options, and allows you maximum flexibility with your portfolio. To begin with, your company will require shareholders. UK companies require there to be at least one shareholder in the company. A shareholder is essentially an owner in the company and as such may receive company profits via dividends. A shareholder can own all of the shares in the company or simply own some of the company's shares, with the rest of the shares owned by other shareholders. For example, in a company where there are 100 ordinary shares and 2 shareholders, one of which owns 20 shares and the other owns 80 shares, then they respectively own 20% and 80% of the company. Being a shareholder typically means that you have voting rights and influence over the running of the company, and you are paid dividends from company profits based on the shareholding you have. For example, a shareholder that has 80 shares out of 100 in a company is typically entitled to 80% of the dividends. As well as shareholders, your company will require directors. A director is legally responsible for the running of the company, and it is a requirement that your company has at least one director in it. Directors have a number of administrative duties, such as the filing of company accounts on time, and can face substantial penalties if they do not carry out their duties correctly. As such, it is wise to use a provider who specialises in a limited company buy-to-let to not only set up and structure the company, but to also manage the ongoing financial and secretarial administration of that company. In order to obtain the best financing options when investing in buy-to-let property through a limited company, it is typically best that the directors and shareholders are natural person owners, whereby the directors and shareholders are actual people rather than another entity such as a trust or another company. Having natural person owners as the shareholders and directors also means that the ownership structure of your company is very clear, which makes it easier to sell your company shares. Selling the property by selling the company shares instead of selling the property from the company allows you to increase your capital gain and significantly reduce your capital gains tax. We will cover the details about this in a later video. In order for you to secure mortgage lending on your properties, it is important that you have the correct technical information in place for your company. If you do not have the correct technical information, then you will limit the pool of lenders who will be happy to give you a mortgage, and you may even exclude yourself from any attractive financing options. Your lender will want to ensure that the company is set up for the sole purpose of holding investment property in order to approve financing for the purchase. Therefore, your company must have limited activities, and these are determined by the SIC code of the company. The SIC code stands for Standard Industrial Classification Code and determines what activities a company can do. For property holding companies, it is typically best to ensure that the SIC code 68209 is used. There are also different types of shares that a company can be made up of, such as ordinary shares and alphabet shares, amongst others. The most simple and straightforward share type is ordinary shares, where each share gives the owner one vote per share. The more complex a share structure, the more likely it is that it will be reviewed by HMRC, as has recently been the case for complex family investment vehicles. Articles of Association are essentially the rules of the company. The Articles of Association set out how the company is governed, as well as the directors' powers and responsibilities. As such, it is worthwhile having a high-quality set of Articles of Association designed for your company, so that it is specifically designed for buy-to-let purposes. The Memorandum of Association is a legal statement signed by all initial shareholders and guarantors agreeing to form the company. The best way to provide your company with the funds it needs to purchase the property is a director or owner loan, for which you will need a loan agreement. Many lenders often require this agreement as a condition to the mortgage. A director's loan agreement allows you to efficiently provide your company with a loan which you can then repay to yourself over time from your rental profits. Debt repayment is not counted as income, as it is not income. It is a repayment of a debt that you are owed. Therefore, the debt repayments that you make are not subject to income tax. It is easy to make a repayment of the director's loan from your company account by making a transfer to your personal one. This repayment will just need to be reflected in your company end-of-year accounts, which is why using someone who understands this to manage your company can be very time efficient for you. It can also be important to understand transfer pricing regulations so that you can set the right interest rate on your director or owner loan. This is especially important as many investors assume that applying a high interest rate to a director or owner loan is an efficient way of extracting profits from the company. However, this is typically not the case, as these interest payments are taxed at income tax rates and therefore means that you are potentially losing money rather than making more post-tax profit. You will need a well-written and buy-to-let specific shareholders agreement to protect your rights in your investment going forward. The Shareholders Agreement sits alongside the Articles of Association, and its purpose is to protect the shareholders' investment in the company, to establish and maintain the relationship between the shareholders, and to govern how the company is run. The Shareholders Agreement is also private, which contrasts with the Articles of Association, which are public, in turn meaning that investors tend to put commercial matters which they want to keep private within the Shareholders Agreement. The Shareholders Agreement lays out exactly how to do certain things and will set out how to resolve any dispute should the shareholders of the company fall out or have a disagreement. This is especially important if you're investing with family members or with joint venture partners. A good shareholders agreement is vital for a property holding company and ensures that it is clear how decisions between shareholders are made about your investment. No shareholders agreement, or a badly drafted one, could leave your rights and investment options unclear and lead to a challenging situation which is costly to resolve. In order to qualify for a mortgage for your buy-to-let investment through a limited company, you'll be required by your lender to have a business account that is compatible with the mortgage lender's requirements. A bank account that you hold in your personal name will not be acceptable here. In addition to accessing mortgages, having a business account for your company also allows you to keep track of all money that enters and leaves your properties, such as mortgage payments, rental incomes, and all other related activities. And for those based overseas, it allows you to make international transfers between the UK and your country of residence. It is important that the account is compatible with the requirements of most mortgage lenders and has features such as a UK sort code, a UK account number, direct debit functionality, the ability to accept different payment types such as CHAPS, BACS and faster payments, and an IBAN and BIC for those based overseas. Finally, a UK company is required to have a registered office address so that any company-related mail and documents can be sent to company directors. Whilst you can use your own address, doing this puts you at risk of a number of potential future problems. This is because using your own address as your company's registered office allows anyone to know where you live, as your address will be detailed next to your name on company's house. People or companies can therefore send unsolicited mail to you or contact you directly at your address. In order to maintain your privacy and overall security, it is best to use a service that provides a registered office as part of their overall offering, in turn allowing you to receive all company-related mail safely and hassle-free. We hope that you enjoyed this video, and if you would like to understand more about limited company buy-to-let, then please check out the other videos in the series, which you will see on screen and to the right of your screen now. Also, check out the rest of our YouTube channel and website to answer all other questions you might have around limited company buy-to-let. If you would like to know more about how to structure your company in the most efficient and valuable way, then please contact us directly either through the link below or through our contact details in the description box. We look forward to speaking with you.